For the last couple of years, let's be honest, the US housing market has felt less like an investment and more like a contact sport. You had soaring prices, these crazy bidding wars, just a constant feeling that you were missing out. But that whole vibe, it's shifting. You can feel a definite chill in the air, and the big question on everyone's mind is, what's next? Are we looking at a gentle rebalancing, or is something more serious coming down the pike? And really, what does this new reality mean for you? In this explainer, we're going to pull back the curtain. We'll start with the big 30,000-foot view of the national market, and then we're going to put one specific county right under the microscope to see how all these huge economic forces are actually playing out on the ground, block by block. Man, the housing frenzy of the post-pandemic years was a wild ride. It created fortunes for some and, frankly, a ton of stress for pretty much everyone else. But as we look ahead to 2026, it really feels like the music is starting to fade. That era of just relentless double-digit price growth, it's probably over. The fundamental things that fueled that fire, I'm talking rock-bottom interest rates and that massive wave of people moving, they've changed. So what comes next? Are we in for a soft landing or something a little more turbulent? Let's get into the data and find out. Before we jump in, don't forget to like, share, and subscribe. And check out the links in the description if you're looking for a real estate agent in your market or you need life insurance. My team and I can help you anywhere nationwide. Okay, so to get the full picture, we've broken this down into 6 key parts. First up, we're going to look at the big national trend, what we're calling the Great Housing Cooldown. Then we'll dive deep into a case study of Sonoma County, California, to see these forces in action. From there, we'll take apart the engines of its local economy and look at the critical link between its demographic shifts and the pressure on real estate. After that, we'll zoom way back out to look at the biggest player of all, the Federal Reserve. And finally, we'll tie it all together to help you figure out your next move in this brand new market. All right, let's start with that 30,000-foot view. After years of what was, let's face it, totally unsustainable growth, the national housing market is hitting the brakes. Now, this isn't a 2008-style crash, but it is a much-needed correction. What we're seeing is a fundamental rebalancing of power, away from that seller-dominated frenzy and back towards something a little more neutral, and in some places, even a little buyer-friendly. This slide right here really drives the point home. We're not just talking about prices growing slower. In some of the hottest markets from the pandemic, prices are actually falling. I mean, look at Austin, Tampa, Dallas. These were the absolute epicenters of the boom, right? They were fueled by this massive influx of remote workers and cash. For years, supply just had no chance of keeping up with that demand. And now, they are leading the charge in this cooldown. This isn't just a tiny adjustment. It's a clear reversal of the trend, and it tells us that the basic math of supply and demand has finally truly shifted. And hey, don't just take my word for it. This quote from Redfin's senior economist Shahryar Bokhari cuts right to the heart of it. It's the most basic law of economics, supply and demand. For years, the story was overwhelming demand chasing way too little supply. Now, that whole equation is being flipped on its head. As he points out, more cities are seeing price drops than at any point in over a decade. So this isn't just about high mortgage rates, it's a deep structural rebalancing that's happening under the surface. So you're probably asking, why? Why is this all happening now? Well, it's not just one thing. It's really a perfect store of 4 key factors all hitting at once. First, that historic wave of people moving to Sunbelt states has finally crested. The flood of buyers heading to places like Texas and Florida has slowed to a trickle. Second, the home builders went into overdrive to respond to the boom, and all those newly built homes are now hitting the market, adding a ton of new inventory. Third, affordability has just hit a brick wall. That 1-2 punch of record high prices and higher mortgage rates has simply knocked a huge number of potential buyers out of the game. And finally, it all adds up to this. Homes are just sitting on the market longer, and that slowly chips away at a seller's power and forces them to get real on their price. National trends are great for telling us what is happening, but they don't always explain the why. Real estate is so intensely local. It's driven by forces that are completely unique to each community. So to really understand how this cooldown works, we have to go from the abstract to the specific. And that means putting a single complex market right under the microscope. So for our case study, we're lacing up our boots and diving deep into Sonoma County, California. Now you know it's world famous for wine and just stunning scenery, but it's also the perfect microcosm of a high-cost, super desirable market that's wrestling with some really deep-seated economic pressures. By dissecting what's happening in Sonoma, we can see exactly how those big national trends we just talked about crash into unique local factors to create the reality on the ground. So what's the state of play in Sonoma? A detailed economic analysis from Moody's paints a really nuanced picture. On the surface, things look pretty good. The job market is stable, right in line with both California and the rest of the country. But you dig a little deeper, and you start to find the cracks. The county's flagship tourism industry is really struggling to get back to its pre-pandemic strength, and its housing market is decidedly cool, with sales volumes near decade lows. It's an economy that looks healthy from a distance, but it's dealing with some major challenges just beneath the surface. Before we can even begin to understand Sonoma's housing challenges, we first have to understand what powers its economy. It's a really diverse ecosystem, built on a few key industries that are both its greatest strengths and, in some cases, its biggest weaknesses. So, what really makes Sonoma tick? Its economy basically stands on four key pillars. You've got the obvious ones: tourism, which brings in a constant river of outside cash, and agriculture, totally dominated by that world-famous wine industry. Now, these create a lot of jobs, but many are in the service industry, which doesn't always line up with the high cost of housing. Then you have a growing manufacturing base, a lot of it tied to high-end food and drinks. But the real surprise here is healthcare. It has been a massive engine for job growth, bringing in well-paid professionals who can actually compete for that limited housing. This mix is a strength, but as we're about to see, each of these pillars has its own issues that directly affect who can afford to live there. And, while that Moody's report mentions tourism as facing some headwinds, there are definite signs of resilience. For example, passenger traffic through the local airport jumped 16% last year. That's a vital sign. It shows that even with all the economic uncertainty, Sonoma is still a top-tier destination that people are willing to spend money to visit. That influx of tourist cash is the lifeblood for a huge chunk of the local economy, supporting countless small businesses and jobs. Agriculture. That's the soul of Sonoma's economy. And on that front, the recent news has been fantastic. Strong harvests in 2023 and 2024, thanks to great weather, gave the economy a major shot in the arm. But looking down the road, there are some pretty big risks on the horizon. The Moody's report flags climate change as a direct threat to the quality of the grapes, the very foundation of the region's premium brand. And as a major exporter, Sonoma's wine industry is really vulnerable to the whims of global politics, where a simple trade dispute could completely wreck profits overnight. It's a classic story, a strong present facing a really uncertain future. Okay, now we get to the absolute heart of the matter for Sonoma, and honestly, for so many other high-cost areas all over the country. This is where demographics, who's living there, who's leaving, who's getting older, collides with the hard realities of the local real estate market. This is where the pressure becomes immense. This chart right here, it reveals a fundamental challenge for Sonoma County. For 7 straight years, more people have been leaving than arriving. A shrinking population is a serious headwind for any local economy. It means a smaller workforce for businesses, fewer customers for local shops, and, in theory, it should mean less demand for housing. But as we're about to see, it's not that simple. This isn't just a blip. It's a long-term demographic shift that is reshaping the entire county. So why are people leaving? This slide tells a really clear story. The overwhelming trend is domestic outmigration, which just means residents are moving to other parts of the U.S. And the main reason, according to the Moody's report, is the absolutely staggering cost of housing. Sonoma is one of the least affordable places to live in the entire nation. It's not a lack of jobs that's pushing people out. It's that the paychecks from those jobs just don't go far enough to cover the cost of a home. Now, you might think, okay, declining population, that should mean a surplus of housing, right? But here's the paradox. This slide shows that is not the case in Sonoma. Even with fewer people overall, the number of new households being formed, young people moving out on their own, new families starting, has consistently outpaced the construction of new homes. This creates this chronic housing shortage that keeps prices stubbornly high. It's this frustrating loop where even as the total population shrinks, housing just gets less and less attainable for the people who are still there. And that supply shortage is being made dramatically worse by a powerful force called the mortgage rate lock-in effect. Look, millions of American homeowners, and a lot of them in Sonoma, either bought their house or refinanced when rates were at historic lows, like 2 or 3%. For them to sell their current home and buy another one would mean trading that amazing low rate for a new mortgage at a much higher rate. We're talking potentially thousands added to their monthly payment. Financially, it's just a non-starter. This effect essentially puts a giant freeze on a huge portion of the housing stock, just strangling supply. So when you put all these pieces together, you see this incredible squeeze on the entire system. You've got affordability that's among the worst in the nation, pushing working families out. You have the lock-in effect preventing existing homeowners from moving up or downsizing. At the exact same time, the county is losing its prime working age population, which shrinks the labor force. And all of this is happening as the remaining population gets older, which increases the demand for services like healthcare, a sector that is already struggling to find enough workers. Each one of these problems just feeds into the others, creating this complex and really challenging cycle. We're at about the halfway point of our analysis. As we get ready to zoom back out to the big picture, just a quick reminder. Before we jump in, don't forget to like, share, and subscribe, and check out the links in the description if you're looking for a real estate agent in your market or you need life insurance. My team and I can help you anywhere nationwide. Okay, we've seen the national cooling trend and we've dissected the local pressures in Sonoma. Now we have to connect all of this to the single most powerful force in the economy, the Federal Reserve. The interest rate decisions they make in Washington have a direct, immediate impact on the mortgage rate you're going to get offered and on the overall health of the housing market. This slide really shows the tightrope the Fed was walking at the end of 2024. See, their job is to balance two things: keep unemployment low and keep inflation under control, right around a 2% target. And according to economist Mark Zandi's analysis, they pretty much managed to thread the needle. They successfully brought inflation way down from those painful pandemic highs without causing a massive spike in unemployment. That was the soft landing everybody was hoping for. And this success is what gave them the confidence to finally take their foot off the gas with those aggressive interest rate hikes. So if they stuck the landing, why did the Fed then tap the brakes on cutting rates in early 2025? Well, Zandi's analysis points to a few things. The economy was still growing strong and the job market was stable. But there was also this deep fog of uncertainty. They weren't totally sure what the new, long-term normal interest rate should even be. And more importantly, there is huge uncertainty about the economic policies of the new administration, especially around things like trade and government spending, which could have easily reignited inflation. Faced with all those unknowns, the Fed chose the safest path. Just wait and see. But here's the thing. The Fed only controls short-term rates. Long-term rates, the ones that matter for mortgages, are set by the bond market. And the bond market got very nervous very fast. This timeline shows you just how quickly things changed. In September 2024, the 10-year Treasury yields, which is the key benchmark for mortgages, was at 3.6%. But as political and economic uncertainty started to grow, investors started demanding higher returns for the risk of holding long-term debt. And in just a few months, that yield shot up a full percentage point. For a home buyer, that translates directly into a higher mortgage rate and a lot less buying power. So what exactly drove that 1% spike? This chart breaks it all down. Only about 15% of it was due to the Fed's decision to pause. Another 25% came from worries about future inflation. But the lion's share, a massive 60% of that increase, came from something called the term premium. And this is so critical to understand. The biggest driver of higher mortgage rates wasn't the Fed or even actual inflation data. It was fear. It was just plain uncertainty about the future. Let's make that concept really clear. The term premium is basically a risk fee. Think of it this way. If you were to lend $100 to your most reliable friend for a month, you probably wouldn't charge them much interest. But if you were lending that same $100 to a less reliable acquaintance for 30 years, you would demand a much higher interest rate to compensate you for the risk and the uncertainty of that long-term loan. Well, the term premium is what global investors demand for the risk of lending money to the U.S. government for the long haul. And when the future looks foggy, that premium goes up. And this chart from the Congressional Budget Office, this shows you a big reason why those investors are so nervous. It tracks the U.S. national debt as a percentage of our entire economy. And as you can see, the CBO projects it's on what they call an unsustainable path. This long-term financial imbalance makes the investors who buy U.S. bonds really uneasy. And that nervousness translates directly into a higher term premium, which means higher borrowing costs for the government, for businesses, and ultimately for you when you go to get a mortgage. So given this whole backdrop, a strong economy, but one with some clear weak spots and a very nervous bond market, Mark Zandi's analysis asks the most critical question of all. What is the single biggest threat we're facing right now? The answer is pretty stark. A sell-off in the bond market. The number one risk is that the nervousness we've been talking about could snowball into a full-blown crisis of confidence. A sudden, sharp spike in long-term interest rates, driven by panicked investors, could do serious damage across the entire economy. And the economy is uniquely vulnerable to this kind of shock right now. First off, asset prices are sky high. The stock market's massive run-up created this powerful wealth effect, which made people feel richer and more confident about spending. A sharp downturn would reverse that feeling overnight. Second, as we've spent this whole time discussing, the housing market is already on shaky ground. Another big spike in rates, which has crushed what's left of affordability and almost certainly trigger price declines. And finally, the commercial real estate sector is still incredibly fragile. Higher rates would make it impossible for many building owners to refinance their loans, and that could kick off that doom loop we've heard about: defaults, foreclosures, and collapsing property values. We have covered a ton of ground. We went from the broad national cool down to the specific local pressures in Sonoma, all the way to the massive macroeconomic forces of the Fed and the global bond market. So now we get to the most important part. What does all of this mean for you? How do you take all this information and actually use it to make smarter decisions? Let's distill it all down into 4 actionable steps. Number 1, become an expert on your local supply. Just like we saw in Austin and Tampa, a rising number of homes for sale is the clearest signal that the market is shifting in your favor. Watch that days on market number. When it starts to climb, sellers lose their leverage. 2, pay close attention to the Federal Reserve. Their pause on rate cuts will not last forever, and any little hint of a future policy shift is going to immediately affect mortgage rates. 3, get your own financial house in perfect order. In an uncertain market, being a pre-approved, financially secure buyer gives you immense power to negotiate and to act decisively when you see a good deal. And finally, number 4, understand your local economy. The Sonoma case study proves that local dynamics are everything. Is your area's biggest employer growing or shrinking? Is the population going up or down? These are the factors that will ultimately drive the value of your home way more than any national headline ever will. So the ultimate takeaway is this. While the national narrative is all about a broad market cooldown, your reality is local. Every single market is its own unique ecosystem, shaped by its own economic engines, its own demographic trends, and its own supply problems. The national data gives you the weather forecast, but the local data tells you what you need to wear today. And understanding that local ecosystem is the absolute key to navigating the market of 2026 and beyond. And this brings us to our final thought. For years, the cost of waiting to buy a home was obvious. You would just end up paying more later. But in today's shifting market, that calculation is infinitely more complex. Waiting might bring lower prices, but it could also bring higher interest rates that completely wipe out those savings. It might mean you have more homes to choose from, but it could also come with a lot more economic uncertainty. The question is no longer just about price, it's about opportunity cost, it's about risk, and it's about timing in a market that is fundamentally rebalancing right before our very eyes. I really hope this deep dive has given you a clearer framework for making sense of all the forces shaping the 2026 housing market. To close us out, thank you for watching. Don't forget to like, share, and subscribe, and check out the links in the description if you're looking for a real estate agent in your market or you need life insurance. My team and I can help you anywhere nationwide. Thanks again for watching.